Chinese tech stocks are once again having a hard time, and it seems to be the reason is the Chinese crackdown on technology and the anti-privacy rules, the Didi issues and so on. But is this really the reason why NIO is tanking? In this video I will address some of the questions that I'm receiving by patrons, for instance, and also give you my thoughts on the crackdown, how I make sense of it, arguments around it, but also talk a little bit more about what this correction could really be all about. Before I dive into the crackdown, let's take a look at Neochart. And well, my pattern has been broken here because I mentioned that NIO needs to remain about this thick blue line, which would be the long-term uptrend. What it did instead is it retested here this thinner line, which is levels where it has previously bounced off, such as here and here. But it seems like today, at least in a pre-market, it seems that it could actually also trade below the support level here once again. So the pre-market readings here from TradingView doesn't seem alright. And then it means that it possibly would look between the 40 to 42 US dollar range somewhere here to find another support level, depending on where this current pressure on technology stocks will actually stop. So of course we currently have this news about the crackdown in China and some media attributes most of the sell-off towards this reason. And if you watch my previous video on this take, I mentioned there are mainly three points. So the first one is a crackdown in the area of fintech, with the prominent example of Ant Financial and their IPO. The second one is about anti-competition rules with the players like, for instance, Meituan and Pinduoduo, but also Alibaba, which have used aggressive policies and sales techniques in order to win the market. And then this has question marks, for instance, around business models like group buying that is used heavily by Pinduoduo, for instance. And the third and the final newest happening in this area is the recent events around Didi IPO and the data privacy usage and the way that they have broken the law in this regard, and the reaction by the government bodies or the regulators in this regard. Now, once again, my summary here is that China is striving for a so-called harmonious society, which is a really important theme by the CCP. And well, what does it mean? It means that they want to have a society that is functioning orderly. So that means something like unfair competition or speculation or stress on the financial system has no place in this kind of society and economy. So that's why this is a really large focus point for the government and the regulatory bodies. Now, instead to just listening to the Western media, how they report about it, let's see what actually the central office or the state office is sending out as information here. And I have quickly automatically translated it for you. So they are stating that they are strictly cracking down on illegal securities activities according to the law. So it should strengthen the coordination between the different bodies like the CSRC to resolutely ban illegal securities trading and as well the consulting around it. And they are explicitly talking about curbing financial risk and also taking out leverage in the system. So this is really, how I mentioned, strictly about a healthy financial system. So that is the main outcome here that they want to have, and that's why they're cracking down, for instance, on meme stocks, on speculative investments, for instance, in some raw materials. We've seen that because of the inflation movements that have been happening there. And then also about the cryptocurrency ban and the mining ban in China. That's all going into this broader theme of regulating the fintech and the financial system here accordingly. Will this have any impact on the tech companies listed in the US? Well, unlikely, unless these companies have been involved in such kind of illegal activities or are part of the financial system and are kind of contributing to speculation in this regard. So for instance, a question could be around Futu and Tiger, which are, for instance, brokerages in China, and yes, they are selling off a lot because of that. And well, it makes a little bit sense because these are, of course, financial players in the system. But in my views, for them, it will be easy to adhere to any new regulation in terms of that they can, for instance, remove asset classes just as they have done as cryptocurrencies from being tradable, and thereby these fintechs shouldn't actually cause major distress in the economy. What is more at the focus of the regulators, I think, are lending services like micro-lending or anything that has to do around the housing market and so on, because this is really kind of feeding into an asset bubble or a crisis regarding debt and also refinancing. So as always, this is not financial advice, but what I can tell you about my personal portfolio, what I'm doing is that I'm still keeping my Tiger Brokers shares. I think I can kind of stomach a setback in these shares, although I do think that Tiger still has a valuation catch-up that it could do potentially in the future. For Futu, I'm currently not holding any shares anymore. In fact, I was actually short selling some call options previously, which I've now covered, and actually I'm possibly looking to get back into Futu at a lower valuation, so that might be actually the case in the next coming weeks. Now let's talk about Didi IPO again, and also the implications on other Chinese stocks, for instance about NIO. First of all, Didi went public despite warnings from the regulators. So I mentioned before in my videos that those companies that knew that they were breaking the law, that they have some issues around these regulations, they are the ones to hold accountable. And actually there are news out there now that Didi actually was warned by regulators to postpone the IPO, which in fact they didn't. They rushed the IPO, and possibly due to the pressure of the existing investors, which are now kind of possibly cashing out, and this is kind of creating all of this trouble around this IPO, because of course the regulators will still enforce the law and the rules around it. And it has been clear that Didi has been in conflict with some of the cyber security laws around data privacy. And so it shouldn't be a surprise to Didi and the management and those investors that this is the case. Now, the problem is what media is making of all of this, because it seems to them like this is a big surprise, and that this is kind of a crackdown that is purposefully happening by the Chinese government in order to teach them a lesson, which is clearly not the case. And frankly, also the reactions that are now proposed to it, which are that the government wants more of a say in whether or not IPOs can actually happen overseas. Because the thing is that the regulators had no way of kind of holding back this IPO from happening, because it's actually a company incorporated overseas in another foreign jurisdiction. So because these Chinese US listed IPOs are always happening in this kind of holding structure format, in which a Cayman listed or Virgin listed company is actually the one that is listing and issuing the ADR shares on, for instance, NASDAQ. And this company is holding in this holding structure the Chinese entities and so on. And this usually, I mentioned that before on previous videos, is a risk to investing in Chinese companies, because it technically could mean that investors in this holding structure are not actually directly holding the assets in the company in China. They're just holding shares in this legal structure, and there are the naysayers or the bears that say that basically the Chinese company could run away with all of the assets being left in mainland China, whereas the investors will be left with just holding the shares in this ADR, which is a Cayman listed company. But that's the general preset of what's happening. And in this case now with Didi and the consequences offered by or proposed by the regulators here, is that they want to make it more hard for future IPOs to list overseas without getting the proper approval before actually doing so. And this is now being translated here into articles like this. which is basically saying that NIO, Li Auto and XPeng all are down because of fear that they in the future would be unable to raise funds, because they are saying that these automakers in the future will not be able to make new offerings, raise cash to do such offerings because of the tightening rules of the Chinese government. And this article is coming from a Motley Fool journalist called John Rosevear, and actually I have read countless of his articles in the past. If I would just followed his advice, I would have never invested in NIO back then when NIO was almost at the verge of bankruptcy, because he is always having such bearish takes on the industry and what's happening. And frankly, I think it's a misinterpretation. Chinese stocks that are, or Chinese companies that are already listed in the US, they should have any issues of offering further shares. They also always have the opportunity to go to Hong Kong, which they're just doing in the case of XPeng and NIO possibly in the future. And in the future, they may also list even on the STAR market in Shanghai, or list as A shares in Shenzhen. So there are various ways of tapping into the capital market. So it is actually not an issue for NIO to raise additional funds or cash reserves if they would need so. And actually they have $7 billion of cash currently, which is a comfortable cash position, not having to build any factories additionally. So this is another wrong take, which I think needs to be debunked in about all of this fear, uncertainty and doubt. The next one is actually what will be the consequences of the bodies investigating these issues in those different areas I mentioned. Well, it turns out there will be a $75,000 fine for most of the companies, including like Alibaba. They have fined 22 companies. And I mean, look at the size of this fine. This is not really a big thing that they may not be able to stomach. I mean, there might be further consequences for sure, and those companies, they really need to adopt their business models and their offerings. For instance, in the case of Didi, they have 15 days in order to become compliant with the cyber security law on the data collection side and so on, in order to make the app reappear in the app stores. And so within those 15 days, those companies will do so and adjust their business model or their offerings in a way that they become compliant, and then they will just start working normally again. So another piece of debunking this FUD here is regarding how severe are actually the consequences of these crackdowns right now. And then another discussion is more also on the political side about the usage of data. I mean, that's coming also from the example of Didi here. And maybe with the question, for instance, like a company like NIO, could there be issues later on that NIO should be able to provide user data to, for instance, US authorities? And my views on that is that there is really not something new. This is already corporate standard practice of becoming compliant. For instance, we have Apple, who are building their cloud infrastructure in China as a separate entity, for instance, to their cloud services in the US. Why is that? Because Chinese law requires that Chinese data stays in China, and actually that's why they have the user data stored in China. And also if the Chinese government, for instance, has a law enforcement request regarding Apple, then they may be able to provide such data to the Chinese government. And that's actually happening the same in the US. For instance, someone was breaking the law, and then the US authorities are coming in asking Apple for instance, the keys to the iCloud, and in some cases they give it out. This is actually just part of the privacy policy of the company, like Apple, like Google, whether or not they comply with the authorities. But what they usually do is that they split the data between different geolocations. And this is also where I think, for instance, companies like Cloudflare are coming in, and that's why I'm invested in Cloudflare, because they have this setup for enabling companies to do this split between different locations. Another example would be Tesla, who is now moving also or building also Chinese data warehouses to move the data of Chinese users just explicitly to China. Another company would be SAP Health, who's now using AWS in the US for hosting the US user data locally in the US. And so, the bridge between the two different cloud systems is, in that case, usually some entity like Cloudflare, which is providing not only the CDN services, but also having ways of having the user data being separated, but still enabling fast internet access for both sides. And that's, I think, is the future. And companies like NIO, they wouldn't have a problem to replicate the same thing. For instance, with the NIO market entry in Norway, we saw that they also make use of AWS. So that also means that NIO is moving or keeping the European data within Europe and thereby becoming compliant, for instance, with GDPR and also other data laws. And there is no way, in my views, that I think the US government would like, for instance, to have access to Chinese user data. They may want to have access to the US user data in case there is such kind of an inquiry, but this has nothing to do with the fact that Chinese data needs to be handed to the US, and that won't be happening. And thereby, there are problems with use cases like, for instance, autonomy features. I think all of the companies will find technical means of a way of becoming compliant, and also on the financial regulation of things. There is a question whether or not Chinese entities will be giving access. So on the financial side, of course, there is the question regarding all of the delisting talk, whether or not Chinese companies will be granting access to US institutions to oversight and recheck the accounts of Chinese firms. But that is still up to negotiations. I think that most of the companies would actually be ready to find a way of becoming compliant with that as well, but this is just still too far out in order to still or already be an issue, and actually it's a separated issue from the current crackdown. So to sum it up, before I talk about further reasons why the stocks are currently trading lower, I think the crackdown cannot be the main source of why this is currently happening. Or in case that is really the reason why investors are selling off, then I think that's actually a wrong signal and a huge buying opportunity, because to my understanding it will not change the prospects and the growth prospects, which is the important thing of the companies, of most of the companies. But I mentioned some examples, for instance, like Pinduoduo, where I think it can have a long-lasting impact. What is interesting in contrast is, for instance, today we have another sell-off of the US 10-year bond yields, so down -4%, which is massive. And this has been all of the talk recently actually about this inflation narrative, which was leading to compressed multiples in tech stocks, notably also in NIO and so on. And now the interesting part here is that despite we see this big reversal in the yield rates here coming down to lower levels, and that should actually be good for technology stocks, yet still we see kind of a big pressure on technology stocks all across the board, not only Chinese stocks. So for instance, BNGO is down 5.7% pre-market, Nvidia down -3%, Tesla -2%, Coinbase, AMC and so on, Palantir. All of these stocks are kind of unaffected by a crackdown in China, right? So the question is, why are also they coming down? And it seems there is kind of a bigger shift going on from equities to something else. I don't know where it's going. It's also not going into crypto right now. Bitcoin is also trading down, but it seems the government bonds yields are trading down. So possibly some investors are actually moving some of the finances into bonds and buying up bonds here, and thereby lowering the yields on these bonds, because the demand is getting bigger for bonds. So this is actually more of a macro issue here, and possibly investors are let's say uncertain about the growth of the economy, maybe also some issues around the new Delta variant and how this may actually lead to new lockdowns over the world. Something like this. I haven't found a clear narrative yet that makes sense to me, but I'm definitely noticing that there is something else happening on the macro side here, which is not aligned just solely to this Chinese crackdown issue. So I would kind of smash down those arguments around why Chinese stocks are tanking because of these governmental issues here in China and the crackdown. Instead, it seems like there is a bigger shift in the sentiment of institutions and investors worldwide. So I'm definitely going to make a catch up on this once I have more insight, and of course going to post insight as soon as I have it in the Patreon network. Anyways, let's see how long this correction will go and where it finds a bottom. For now, it seems to be a bearish sentiment in the markets. Let me know down in the comments why you think this sell-off is happening. Is this a larger correction, which of course many have been warning it recently, but these voices are always there, so that's not a surprise. Anyways, thank you guys for watching. Please smash a like if you enjoyed this information and you found it valuable, and then see you in the next one.